Hello friends. Imagine checking your bank account on the first of the month, expecting your Supplemental Security Income deposit, and finding absolutely nothing. You call the Social Security Administration in a panic, only to be told that your benefits have been completely revoked because your checking account had exactly $2,015 in it. For millions of America's most vulnerable seniors and disabled adults, SSI is their only lifeline to survive. But the SSA monitors SSI recipients with an iron fist, enforcing brutal financial limits that haven't been updated since 1989. In 2026, failing to report a simple address change or accepting too much help from a family member can trigger an immediate suspension of your checks, but the government has quietly rolled out massive new rule changes regarding food and rent. And if you know how to use them, you can legally accept help without being penalized. I want to be perfectly clear right from the start. The government isn't illegally stealing your money, and this isn't a scam. This is the official, strictly enforced federal rulebook for the Supplemental Security Income, SSIA program, which operates under completely different laws than standard Social Security retirement. Stay with me until the very end, because I'm also going to reveal the 2026 ABLE expansion. This is a massive brand new federal law taking effect this year that allows millions of older adults to legally hide up to $100,000 from the SSA without violating the asset limit. But you have to understand that these rules change every single year, and the government is never going to call you up to explain your options. The people who subscribe to this channel find out about these updates in time to protect themselves. The people who don't subscribe usually find out after their money is already gone. Take a second right now to hit that subscribe button so you always know what's coming before it hits your wallet. Let's look at the first hidden trap that catches thousands of people off guard every single month. The first of the month asset test. To qualify for and maintain your SSI benefits, your total countable resources cannot go over $2,000 if you are a single person or $3,000 if you are a married couple. Congress has not raised this limit a single penny since 1989. The way the Social Security Administration enforces this is incredibly strict. They check your bank balance electronically on the very first moment of the very first day of the month. If you are even $1 over that limit, your entire check for that month is instantly suspended. To protect yourself, you must follow a deliberate, step-by-step action plan every month. First, you need to clearly differentiate your exempt assets from your countable assets. Your primary home, one vehicle that you use for transportation, and your regular household goods are completely exempt. They do not count toward the limit, but your cash, your checking accounts, your savings accounts, any stocks you own, and the cash value of any life insurance policies are fully countable. Step 2 is to check your bank balance on the 28th day of every single month. Step 3, if you see that your balance is going to be over $2,000, and that balance does not include the new SSI deposit you just received for that upcoming month, you must spend that excess money immediately on valid living expenses. Go buy groceries, pay your rent early, or pay off outstanding medical bills. Finally, step 4, keep every single physical receipt to prove that spend down happened before the clock struck midnight on the first of the month, just in case the SSA decides to audit you. I know how that sounds, but look at what happened to John, a 68-year-old senior living in Texas. John is on SSI and normally keeps about $1,900 in his checking account. One afternoon, he decided to sell an old guitar at a pawn shop for $150, and he deposited that cash into his account. When the first of the month rolled around, his bank balance sat at exactly $2,050. Because John crossed that line by just $50, the SSA legally suspended his entire SSI benefit for that month. Since the 2026 maximum federal benefit rate is roughly $994, John lost $994 in real income, all because he saved an extra $50. If he didn't catch this mistake and fix it immediately, that single pawn shop trip would have cost him $11,928 over the course of the year. There is a critical situational variation you need to write down. If you leave your SSI check in your bank account unspent during the month you receive it, that specific money does not count as a resource for that specific month. But the exact moment the calendar flips into the following month, any leftover cash from that previous check instantly converts into a countable resource. If that leftover money pushes your total balance over $2,000 on the first day of the new month, you are penalized. While the asset limit is brutal, the timeline the government gives you to report changes in your life is even tighter. That brings us to the monthly life change audit. Under federal law, you are legally required to report any significant change in your living situation, your income, or your marital status to the SSA no later than the 10th day of the month following the month the change occurred. Failing to meet this exact deadline is the number one reason seniors get hit with massive overpayment clawbacks years down the road. If your situation changes, you cannot wait around until your annual review to let them know. You have to take action immediately. First, identify if a reportable event has actually happened. This includes moving to a new apartment, having someone move into your home with you, getting married, or earning even a few dollars from a side job. Second, do not wait. Third, log directly into your My SSA portal online, call the main hotline at 1-800-772-1213, or use the automated SSI telephone wage reporting system. Fourth, always write down and save your official confirmation number to prove you hit that 10-day reporting window. Look at Susan's situation. Susan is 66 and relies on her SSI check to get by. In March, her adult son fell on hard times and moved into her spare bedroom to get back on his feet. Susan figured it was temporary and none of the government's business, so she did not report it by the April 10th deadline. The SSA found out a full year later during her annual redetermination review. Because an extra adult living in the house changed Susan's fair share of household expenses, the SSA retroactively reduced her past benefits by $100 a month for the 12 months her son lived there. She was hit with a sudden, devastating overpayment demand for $1,200. If Susan had simply reported the move by April 10th, her check would have adjusted cleanly from that point forward, and she would have completely avoided a massive debt crisis. Keep in mind that a senior living on regular Social Security retirement does not have to report if their son moves in. This strict 10-day micromanagement applies exclusively to the needs-based SSI program. This rigid household monitoring used to include everything you ate until the government finally passed a massive, desperately needed rule change. That brings us to the brand new in-kind support and maintenance food rule overhaul. Historically, if a well-meaning family member bought you groceries or paid for your meals, the law considered that food to be unearned income. The system would brutalize your check, reducing your SSI payout by a full 1/3 because you were receiving outside help. But under a massive federal rule change that is fully active for 26, the government has completely removed food from the equation. To take advantage of this protection, you need to understand exactly how the new rule operates. Step 1 is to acknowledge the legal shift. Your family and friends can now buy you unlimited groceries or take you out to restaurants without your check being reduced by a single penny. Step 2. Inform your family members that they can safely drop off meals or stock your pantry. Step 3. If a local Social Security agent attempts to ask you about who pays for your food during an official interview, firmly remind them of the new federal food exemption. Step 4. Do not let your family give you raw cash to buy the food yourself. They must buy the groceries or meals directly and hand the physical items to you. If they give you cash, that cash is still treated as countable income. Let's look at the real-world math for David. David's daughter drops off $300 worth of groceries at his house every single month because David's $994 SSI check simply isn't enough to cover his bills and food. Under the old rules, the Social Security Administration would deduct roughly $331 from David's monthly check because he accepted that food, leaving him with a tiny payout of just $663. Under the new 26 rules, the government ignores those groceries completely. David gets his full $994 check and his $300 in free food. The single update legally restores $331 a month, which adds up to $3,972 a year, directly back to David's household wealth. There is a critical variation you must remember. While food is now completely exempt, shelter expenses are still heavily monitored under the old rules. If your daughter pays your electric bill, your gas bill, or your rent directly to the landlord, your check will still face that automatic 1/3 reduction. Because shelter is still monitored so aggressively, moving in with family to save money is a massive financial risk for an SSI recipient. But there is a second new rule that provides a legal shield for your housing, and it is known as the Presumed Maximum Value Rent Loophole. If you live in your adult child's house and they do not charge you the official market rate for rent, The government considers that a rental subsidy and cuts your check by 1/3. However, the agency recently expanded a protective rule nationwide to solve this problem. If you pay a specific rental amount equal to the presumed maximum value, which is mathematically defined as exactly 1/3 of the federal benefit rate plus an extra $20, the law legally considers you to be paying your fair share of housing expenses and they cannot touch your check. Here is how you execute this strategy step by step. First, take the current federal benefit rate of $994. Second, calculate your required rent by dividing 994 by 3, which gives you $331, and then add $20. Your target total is exactly $351. Third, sign a formal written lease agreement with your adult child agreeing to pay them exactly $351 a month in rent. Fourth, present that signed lease to the Social Security Administration to prove you are paying the official benchmark rate, completely protecting the rest of your monthly benefit. Consider Mary, who moved into her son's basement apartment. A normal basement apartment in her specific city carries a market rent of $1,000 a month. Her son knows she is broke, so he lets her live there for $0 down. Because Mary pays $0 in rent, which is far below market value, the government slashes her $994 check by $331, leaving her with just $663. Now look at what happens when Mary uses the loophole. She signs a formal lease to pay her son exactly $351 a month. The government sees the lease, accepts that she is meeting the federal benchmark, and restores her full $994 check. When you subtract the $351 Mary pays her son, she is left with $643 in her pocket. That is $20 less than she had under the penalty. But here's the trick. That $351 stays inside the family economy instead of being completely erased by the government. Over the year, Mary's family retains $4,212 in total wealth. As a major situational variation, you need to know that this rental subsidy protection used to be available in only 7 states due to local court rulings, including Texas and New York. In 2026, this protection has been officially expanded to cover all 50 states nationwide. Navigating these rental agreements and managing monthly expenses can become incredibly difficult as we age, which is why millions of recipients have a caregiver or adult child step in to manage their money. But doing this incorrectly creates a massive audit risk known as the Representative Payees audit trap. If an SSI recipient cannot manage their own finances due to a condition like dementia, the government appoints a representative payee. The number one reason these payees get audited and the seniors' checks are completely cut off is the commingling of funds. The person managing your money is legally forbidden from mixing your SSI cash with their own personal funds. To keep the inspectors away, your payee must follow these exact steps. Step 1, go to the bank and open a completely separate, dedicated checking account. Step 2, ensure the account is titled precisely as your name as Representative Payee for the senior's name. Step 3, never deposit your own paychecks, birthday cash, or personal money into this account. Step 4, keep a physical paper ledger tracking exactly every dollar that goes out for rent, medical care, and food so you can hand it over during the annual accounting report. Look at Robert, who manages his 80-year-old mother's monthly checks. To make things simple, Robert had the government deposit her $994 check directly into his personal checking account so he could easily swipe his card for her groceries. When the Social Security Administration audited Robert, they found the funds commingled. Because the money was mixed together, they legally assumed the $994 was being spent on Robert's personal life instead of his mother. They suspended the mother's check immediately. To make matters worse, because Robert's personal account had $5,000 of his own savings in it, the government claimed the mother was over her individual $2,000 asset limit. The check stopped completely, locking the family into a months-long legal battle just to prove where the money went. For a quick situational variation, if you are a spouse acting as a representative payee for your husband or wife, you are generally exempt from submitting the annual written accounting form, but you are still legally required to keep the funds completely separated if an investigator asks. If a mistake does happen, whether it's made by you or your representative, payee, and the government demands thousands of dollars back, a new safety rule stops them from completely starving you out. This is where the maximum recovery rate rule changes everything. In the past, if you broke an SSI rule and were overpaid, the Social Security Administration would aggressively seize 100% of your future checks until the debt was entirely paid off. This brutal practice instantly left thousands of vulnerable seniors completely broke and facing immediate homelessness. Thanks to a recent policy overhaul, the default recovery rate for SSI overpayments is now strictly capped at a maximum of 10% of your total countable income. When you get hit with one of these letters, you have to follow a clear 5-step strategy to protect your monthly cash flow. Step 1. Receive the official notice of overpayment letter and read it carefully. Step 2. Look specifically at the payment withholding section to see exactly how much money they intend to take out of your check. Step 3. If they threaten to withhold more than 10% of your benefit, call the main hotline immediately at 1-800-772-1213. Step 4. Demand that the representative apply the default 10% withholding cap to your case. Step 5. If that 10% reduction still leaves you completely unable to buy your food or pay your bills, request and file Form S SA-634 to ask for an even lower monthly repayment rate, such as $10 a month. Let's look at the real numbers for a senior named Linda, who receives a standard $994 monthly SSI check. Linda received a sudden letter stating that she was overpaid $3,000 2 years ago because she took a temporary seasonal job and forgot to report her earnings to the agency. Under the old rules, the Social Security Administration would have held back her entire $994 check for 3 full months, leaving Linda with $0 to live on. Under the new 10% rule, the government can only withhold roughly $90 a month from her check. Linda still receives $895 every single month to survive on. While it will certainly take her much longer to pay off that $3,000 debt, she completely avoids immediate eviction and retains nearly $2,700 in critical cash flow over those first 3 months when she needs it most. There is an important situational variation to keep in mind regarding this protection. If the agency proves that your overpayment was the direct result of intentional criminal fraud, meaning you intentionally lied about a disability or hid assets to trick the system, the government retains the legal right to ignore the 10% cap and forcefully garnish your entire check until they get their money back. Now, keeping your balance under that tiny $2,000 asset limit we discussed earlier might seem completely impossible over the long run. But on January 1st, 2026, the federal government activated the greatest legal shield in the history of the SSI program, paying off the massive shift I teased at the very beginning of our conversation. This program is called the ABLE Act, and it allows you to legally shield up to $100,000 from the Social Security Administration. An ABLE account is a special, tax-advantaged investment account where the money you save is completely ignored by the SSI asset test. Historically, you only qualified for this massive loophole if your disabling condition formally began before the age of 26. But effective January 1st, 26, the Public Age of Onset Expansion Act officially raised that qualifying age limit to 46. This single change opened the door for millions of older Americans to qualify overnight. To use this shield, you must follow these specific steps. First, verify that your disabling condition, which can include severe physical disabilities, blindness, or chronic psychiatric conditions, formally began before your 46th birthday. This is true even if you didn't actually apply for SSI benefits until you were 60 or 65 years old. Second, go online to your state's official ABLE account website, such as Abileno or Calable. Third, open the account and legally transfer your excess cash, gifts, or unexpected inheritances directly into it. Fourth, use your provided ABLE debit card to pay directly for qualified disability expenses, which legally include your housing, your transportation, and your medical bills. Let's look at the dollar math for Susan, a 65-year-old on SSI whose severe physical disability formally began when she was 40 years old. Her brother unexpectedly passes away and leaves her a $20,000 inheritance. Without an ABLE account, that $20,000 hits her standard checking account, completely shatters her $2,000 individual asset limit, and causes the government to permanently revoke her $994 monthly check, costing her $11,928 a year in lost income. But because of the 26 expansion, Susan qualifies for the loophole. She routes the $20,000 inheritance directly into her new ABLE account. Her countable assets stay at $0. Susan keeps her $20,000 inheritance, and she keeps her $11,928 in annual SSI income. She has legally shielded $31,928 in total wealth that the government would have otherwise destroyed. For your situational variation, remember that you are never forced to open an ABLE account in your own home state. If your local state program charges high monthly maintenance fees, you can legally shop around and open an account in a completely different state that offers lower fees and better investment options for your future. Every single piece of the SSI program is fundamentally designed to test your financial endurance month after month. We have covered how the first of the month asset test can wipe out your income over a $50 mistake, and how the strict 10-day reporting deadline can slap you with a $1,200 overpayment if you don't report a change in your household. We looked at how the brand new food rule saves you $331 a month when family drops off groceries, and how the $351 presumed maximum value lease agreement keeps your housing money inside the family economy across all 50 states. We exposed the Representative Payees trap that locks families in court over commingled bank accounts, and we mapped out how the 10% withholding cap protects your cash flow from sudden $3,000 repayment demands. Finally, we deconstructed the historic 26 ABLE expansion that lets you protect a $20,000 inheritance using the age 46 rule. The Supplemental Security Income program is designed to test your financial endurance every single month, but by leveraging the new food exemptions and the 2026 ABLE account expansion, you can finally build a safety net without the fear of government retaliation. Subscribe, share this with someone you know who's on Social Security or Medicare. I'll see you in the next one.